Good day, fellow investors. Now we're continuing with our analysis of Chinese stocks, Chinese interesting investment. And one of the interesting investments is Vipshop Holdings, a fashion online Chinese retailer that has enjoyed good growth and has been able to withstand the attacks of larger competitors. So let's dig into the company and see whether it is a good investment and what are the risks, most importantly. Vipshop is one of China's leading online discount retailer for brands. So they sell brands at discounts, mostly at flash sales. So they get some inventory from a company and then they sell it at a discount online. There is huge potential, however the growth is not that big as we have seen in YY and Momo. China's online shopping market is expected to grow at 10-15%, which is good. However, it increases the risk because of potentially intensifying competition. Nevertheless, Chinese offline discount retail is extremely underdeveloped. The US is the target, and probably in the future China will reach the US level. So there is much potential. Now, the potential and risk for VIPs. They are cooperating with other bigger platforms where they can scale their position. However, those platforms can also do what VIPs is doing by themselves. So that's always a risk that we have to keep in mind. But that risk is not yet present in VIPs numbers. As we can see here, their customer base is growing, their repeat customers is growing, so Vipshop is really establishing itself as a good, important player in the Chinese online retail. The growth in the number of orders and revenue has been very significant, but as you can see, is slowing down. Slowing down growth, and if it slows even more, lower than expectations can be very detrimental to the stock. And what we have already seen is that even that last growth is significantly impacting margins. Gross profit margin has gone from 25 now to 23.2 in the last quarter. This means that the competition is intensifying and margins are getting squeezed. So really something to analyze and check before investing. The gross margin fell 2%, the net margin is still relatively stable. Don't know how can that happen. Therefore there is a risk that the net margin gets hit even higher. So again, something to watch carefully. The price earnings ratio is 23.3 for a growth company expected to grow 10 to 15%, which is good. Liabilities are 73% of assets, though there is no margin in the book value. Price to book value is extremely high, and price to cash flow is also not that stellar. We have seen much better valuations from Chinese companies and that sell at lower price to earnings ratio. So when compared to other Chinese investments, there are better investments than VIPs. Now, something that I don't like when investing in a company is dilution. If you are a shareholder and you get constantly diluted, your ownership of the company gets smaller and smaller. Thus, your value gets smaller and smaller, even if the company grows. And with VIPs, there has been significant dilution. Okay, I can understand in the beginning when the company is growing, but why there is more dilution now, when the company should be doing good? So that's a question to raise. Another thing it's very interesting is that the cap spending is huge and getting huger. So the company did not reach a necessary level of operational quality, and they constantly need to reinvest their money in order to make more and keep the level of growth, which is declining and margins declining. So very, very tough environment. Again, something to really check before investing. Then what they are doing, they are spinning off their internet finance businesses, spin-offs, company ownership, who will take ownership, are they creating or destroying value? Again, I don't like spin-offs personally. If it's valuable, keep it. If it's not valuable, sell it. Another thing that will lead to more dilution is the senior convertible notes due to 2019. Okay, again, dilution in the future, so even more dilution expected. Something I don't like. So we have a company that is growing, but the capex is growing. They need to invest much more to keep the growth, and their margins are falling. For a price-earnings ratio of 23, which for China is a bit high because there are better investments with low price-earnings ratios, higher margins of safety, higher growth, and better cash flows. So it's a good company. It will probably do well, or it will be bought out by somebody else. There have been also rumors that J.D. will buy it out. So it's a very interesting, attractive thing. But the margin of safety is much smaller than in other companies, and the environment is much, much more difficult to operate in. Competition, so you can see J.D.com, something similar, much bigger company, much more power, much more money to make investments and compete. So they have the scalability. And they're also building national warehouse network with a last mile reach that can really compete with Vips. And if you do that online shopping, you easily compare it to other platforms that are selling and buy at the cheapest. Usually the cheapest is the largest. Look at what Amazon has been doing. Vipshop is focusing on discount products, the same as JD, Alibaba, Jumi, and so are also doing. So very intense competition, growth slowing down, and I don't know if they will be able, with the huge capex, to inflect that. So it might be a long declining story for the company. So that's just my view. For me, it's just a little bit too much risk. It will probably be a good investment, good long-term investment. There is somebody will buy it for the warehouses, for the distribution, for the model, for the customers. So let's say a good long-term investment. But there are better ones out there. And if you follow us, you can already see some better investments in our Chinese stock videos. So don't forget to click like if you like the content. Please subscribe for more Chinese videos and to look at the past ones. And I'll see you in the next video.